Hello, YouTube, and welcome back to another weekend deep dive. My name is Justin, and this weekend we're going to try to answer whether or not the stock market crash is canceled. Meaning, is it over? Is the bull rally dead for 2022? And we have to make sure we keep that in mind because this week we have big tech earnings coming up. We've got big companies reporting like Tesla and Netflix this week, and we're going to circle back and talk about that a little bit later. But as we look here at the chart. Again, the big question is it over? There is still a last stand for the bulls to make. And this is going to be really important because we have been dipping into earnings. So as we dip into earnings, what does that mean? Well, it means that it is easier to rally. That does not mean it is a guarantee either. As we look here at the chart for QQQ, what we can notice that we do have this inverse head and shoulders pattern on the daily. And if this pattern breaks, it's going to be very difficult for me to remain bullish. And the reason I say that is because we see the volume dropping off here. So generally speaking, when the volume drops off and the pattern is clear, the next break with the volume to confirm is going to be the decisive move, which means if we poke below this 334.15 area, and we also see an uptick in volume, I'm pretty much going to be saying that is confirmation that the bears are flexing again, right? They're definitely flexing here. And the question is, are they going to flex again to drive us down and break this pattern? So why is this level so important here at 334? It's really important because as we look over here at the QQQ monthly chart, we can note that that 334 area we look at is the low from January. It's so critically important because if this breaks, it means we're pretty much going to be going back down to test these lows here for the year. We're looking at about 317.50. And the reason why this is not good is because, like I mentioned, we have those big tech earnings coming up this week. The market is now flipping back here into fear. We were rock solid inside of neutral, and now we've ticked back down into fear, which means that it might become a self-fulfilling prophecy where we go lower. Not looking all that hot. We can look over here at the heat map as well, and it's pretty obvious that there's some deep pockets of red here. This is for the last 1 week. And as we look here to year to date, it doesn't look like there's very much of a trend change in terms of what is getting red. Why? Well, look, chips over here are leading the decline. Tech is just behind it, and pretty much everything else is treading water. When we go through and look at the charts a little bit later in the show, you will see what I mean, and notably RSP and DIA versus SPY and QQQ. All right, so with that out of the way, I want to jump forward to one more section here, and then we'll go forward. So what's notable here is that we do have those big tech earnings coming up, and I'm talking about the FANG MGs, right? Maybe even the TANG, right? So we got Netflix here on the 19th. We got Tesla over here on the 20th. We've got Microsoft and Alphabet here on the 26th. And then we got Meta on the 27th. And we've got Apple and Amazon on the 28th. I'm only counting the guys that are really big. And then I believe we got NVDA a little bit later in the month, but it is not quite yet confirmed. So what that means is that going into the end of the month here on the 29th, we're going to have all of these big tech earnings reporting. And as we noted, looking here at the heat map, these charts don't look, the performance does not look all that great. They're definitely leading the decline, and a lot of these charts are resting right on key support. So it's really important in terms of where they go this week, and we'll go through that in a moment here. I want to start off by actually looking at some options here. And the reason why is because these calls are MIA. They are missing in action. So just quickly looking here, a few indicators are already telling me that we need to be mindful of the downside potential. And just after OPEX here, we might get a knee-jerk reaction. We might get an opposite move, which means that we're going to be taking a tick down before we tick back up. But if we're going to be, again, closing at the low, what it also means for us is that we're building up pressure. So we were saying that we had 3 white soldiers when we were going up. Well, pretty hard to ignore that we're closing at the low of the week for the last 2 weeks here. So what does that mean? Well, pressure's building up to the downside, right? Drive it down, close at the low of the week. Drive it down, close at the low of the week. All that's missing is volume. So if we get one more tick down and we get that volume to confirm it, that is where things start to get very, very interesting. And the reason why it gets very interesting is because as we look back here to this previous box or the range from the big fat green bar, there's volume that's trapped. So this volume here is now trapped. Why? That's the volume that transacted during this range right here of roughly 334.15 up here to about 358. So if these shares now go red and they don't want to let a green trade go red, what's going to happen? They're going to sell and create that sell-off down into here. So that is really what I am most mindful of this week. And as I look forward to the options chains, I'm not seeing a lot of confirmation for the bulls here. I'm actually noticing that for SPY starting on Monday, there's 100% of bear tilt. There's open interest. There's put flow all the way down to 430. There's also continuation going through to April 20th, which is going to be Wednesday. And again, calls are pretty much MIA. 440 is still max pain that I am noticing. And into Friday, definitely got a bear tilt too. Why? We got open interest, we got volume, and these calls are anemic, right? They're almost not visible at all. As we move forward to the next monthly chain, which is going to be the SPY May monthly, we note that the calls are MIA again, and we see that put flow continuation all the way down to 430. So what does that imply? Well, with right $8 in premium on these 430 puts, that implies that we're going to be at 422, and that is another key area. Why? Well, let's look here at SPY. So as we look here to our monthly low, what do we have here going back to our previous quarter? Let's go to our monthly chart. My apologies. Let me flip here to the monthly. Here we go. So that same level we were looking at for QQQ, again, which is going to be the January low, or roughly where it's sitting right here at 334 for QQQ. Over here, we got 420.76. What is that? That's pretty much the level that we're looking at here if these 430 puts into the next month are going to become in the money. So again, roughly 422 is where they break even, and then they become in the money a little bit lower. There's open interest, there's volume, and the bears seem motivated. So if they didn't get paid this month, they're probably going to try to flex into next month. And what? Yeah, they're going to try to flex again, right? Not fantastic for the bulls, but again, we're looking for what is happening, not what we want to see. Moving forward to QQQ, we can note a lot of the same here. I'm noticing that we got roughly 340 as max pain, and it appears that they are using the same numbers on SPY and QQQ again this week. Again, 440 SPY, 340 QQQ. As we look forward to Wednesday, very muted, but again, mostly puts, not really that notable though. But as we move forward and look to Friday, the 22nd, this is where we see volume, open interest, and continuation. Where? Lower. Where? 335. Not great either. Looking forward to the May monthly. What do we note here? Oh, crap, right? What do we get? 345, 340, 335, right? Lots of volume here at 340 as well. And again, the calls are missing in action. Why? There is not a single open interest area here on the call side that has more than 7,000, right? Nothing more than 10,000, which means that the bulls don't really think it's worthwhile to purchase these. They're more worried about downside risk. So as we go forward here, the reason why that matters is, again, as we look here to why bull or why bear, this week is going to be more of the same if the bears are in control. Why? Again, closing at the low of the week with light volume just means that no one's really fighting the decline. So again, why would we be bullish for this next week? Well, we're dipping into earnings, which means it is easier to rally after earnings. Does not mean we will, by the way. It just means it will be easier to. Dipping into earnings near support means that it will be easier for us to advance. Tina, right? That's looking a lot less likely right now, but again, still one of the bull cases. So why we would be bullish. We have for the bear potential here, we got 454 as an impenetrable fortress. And as of right now, it appears like it is. I say that because as we look here to the weekly chart on SPY, again, we got a bear pivot here off of 454, right? Poked it once, poked it twice, just like we did back here in February. What happened? Boom. That was the low of the year. What happened here? We rallied back up. We poke above once, poke above twice, and there we go. Lower high, lower low, lower high, lower low. Right back down here to the trend line. We'll see what happens. We have DXY and TNX breaking out. Yep. So as we look over here to TNX, what do we have? Well, we have a multi-decade monthly chart bull break. This is terrible for stocks. The other reason why it's terrible for stocks is because the ECB is basically not going to be doing anything. This chart here is very bullish, right? We're up 20% of the month here. We're at almost 3% interest on the 10-year note. That is high. There's a chance for it to come down, but as we look around the rest of the world, again, European bonds ripped, right, by ECB's go slow approach to inflation. Gap between German 2 and 30-year yields jumps the most since 2020. What does that mean? They're calling it slowflation. They're in no hurry to raise rates, which means that as people are looking for yield, they're flocking to America and the 10-year note. As a reminder, As the 10-year note continues to rise, it adds pressure to tech stocks notably. And then for DXY, that is going to be adding pressure to the broader market, S&P notably. So as we look here, again, on our weekly chart, we can note that DXY here is putting in a W pattern. So in the shorter term here, it's putting in a W. As I'm recording the video, it's over 100. And that is what I mentioned I wanted to see for a decisive win and a bull break on DXY here. So, right, higher high, higher low. It looks quite bullish. And the reason why that could be a little bit scary for the bulls is because as we look forward here to the monthly chart, we have an area here at about 120 and an area here at about 106 that could add additional pressure to the market. For every 1% that DXY goes up, it roughly corresponds with about a 1% decline on the broader market. So again, as we look here, right, roughly 6% and roughly 20%. If we move those numbers over to SPY, what do we get if we decline by roughly 6%? Oh, right back down to those yearly lows, almost perfect. Yep. So again, this is not fantastic for us if we are bulls. If we get a 20% decline from here, yeah, that's going down into the nosebleed section, right? So how much further down do we got to go from roughly here? I think it's about 380. Nope, it's even lower, right? We're going to be limboing down to roughly 350. Oh, goodness, right? That's definitely going to be bringing some pain if we go down to there. So there we go, right? Tech is also leading the decline as we noted on the heat map. We're going to look forward now to the surprises. We got Jerome Powell speaking on Thursday, so that's going to be important. We got earnings kicking off and whether or not anything is going to happen in Russia, right? I don't know. Would love to see it. I don't know. We will. For April, the key dates that are going to drive the market this week include Tuesday, the 19th with Netflix earnings. On Wednesday, we got Tesla earnings. On Thursday, we got jobless claims. And on Thursday, we got Jerome Powell speaking. Other big key events are going to be on the 26th, we got Microsoft and Google. On the 27th, we got Facebook. On the 28th, we got Amazon and Apple. And to tie it all together for our base case for the week ahead, this TINA is looking a lot less likely, but it does not mean it is invalidated as of yet. 454 SPY pivot still in play. Why? We're halfway through the month. So we got to look and see where the second half of the month unfolds. Number 3, bears and bulls fight for direction after the 454 pivot. As of right now, there is no edge. I'll explain in a moment why I still believe there is no edge. Earnings confirmation move starts on the 19th and completes with the 28th when we got Apple and Amazon finishing off earnings. So let's touch on this point right here regarding bulls and bears fight for direction with no edge. I'm going to be focusing on the SPY here, and just because, again, it's the broader market, not just tech focused. So what I would say here is that what did we do? Well, again, we had our dip, we come back down, we close above the 50 MA 1, 2, 3, 4 times, and then we close below it once. So that is going to be 4 for the bulls, right? Let's actually do a quick little grid here. So we got we got the bulls, and then we got those bad bears, right? We'll put the B and we'll put the E. So we got the bulls over here. They got 4 weeks over the 50 MA. The bears got 1. All right, cool. Over here, what do we got? Well, we advanced by roughly 11%, and then we decline by about 5.5. What is that? Well, we go up by a full 1 times, and then we retrace by about 0.5 times. We retrace half the move. What is that? That's a back test. Oh, that's a back test? Yep, that is a back test. Is it going to lead to more downside? That's what we want to be mindful of, because if these bulls were wrong when they were buying, and that's quite obvious here when we look at the SPY monthly chart. If we look here at the monthly chart, what do we notice? Well, December dip buying, January dip buying, February dip buying, March dip buying. Oh my goodness. If all that volume becomes red, what's going to happen here? Uh-oh, right? Look out below. And the reason why it's very notable to me is because as we look forward to this range right here, which is where the real bodies are, that is where, that's where people wanted to buy the dip. Why can't I get my triangle here? So again, looking at the range here from these boxes, what do we have? Well, the wicks start here at about 450, and they go down here to roughly 436. So that means that every time we poked below roughly 435, the bulls came in to buy it up aggressive before the month closed out. It is currently April 15th as I'm recording the video. What does that mean? We got half the month left. If we're going to dip down. What do we have to do by the end of the month? We have to rally back up. On the back of what? On the back of big tech earnings. Why? Basically, the last calendar day of the month is going to be Apple and Amazon. And Apple over here is expected, but not confirmed, to deliver a $90 billion share buyback when they do earnings. So if that does or doesn't happen, we're going to have either the buyers come back in and buy again another time below that 435 area, or they're going to fold. I don't know, to be honest. It's we don't know, right? So now let's go through the bull case here. So the bull case is that we got big tech earnings coming up. As we noted before, the reason why we would be bullish or the reason why we would be bearish is because, oops, my bad. Let me get back to the slide here. What are you doing, PowerPoint? There we go. Why bull or why bear? Dip into earnings will be easier to rally and Tina. So let's quickly go through here and let's actually look at these earnings whisper reports here. So what I would say is that, right, we got Apple here coming up. We're expecting a beat, right? We're confirmed for the 28th here. The difficulty is just that it's not a huge beat, right? 157 divided by 143. We're looking for roughly a 10% beat. And that comes at the end. Netflix is now confirmed for the 19th. No whisper number here. So, right, we're kind of flying blind. We don't really know what's going to happen. And there you go. Tesla has already pre-announced their vehicle deliveries. They are confirmed for the 20th. They're expecting a beat of roughly 6%. I don't know if that's really all that impressive. They are delivering quarterly profit. They did miss the vehicle deliveries for last quarter, though. So, again, I think that Tesla is going to be more important than Netflix, but between both of them by Wednesday, they will be reported. And then as we look forward to the rest of these big tech, we got Microsoft here reporting on the 26th, 227 divided by 218, only expecting about a 4% beat, but it's still a beat. The guidance is going to really matter here for these companies as well, because we really want to know whether or not they can pass off the costs of inflation to consumers. Google for the 26th, but not confirmed, no whisper number. Amazon for the 28th, confirmed, but no whisper number. Then we got Face Stink here, expecting a miss. So we got 249 over 261. So we're looking for a miss of roughly 4.5%, confirmed for the 27th. And then NVDA, I believe, reports last, May 25th, a ways off, right? Confirmed, no earnings estimates. So what does that mean? Again, let's look back at our notes here. Dip into earnings makes it easier to rally. It does not mean it's a guarantee either. So now let's look through those trillion-dollar companies charts, and then we'll look at QQQ to try to smooth it out and get the understanding of what is happening. So looking here, we got Apple doing what? Well, it's poking below 165. Again, this is the king. It reports last. If it's going to start declining, it could easily shoot back down to roughly 155 here, about 10 more points. That is going to drag on the market, and it doesn't look bad. Apple is still definitely the most bullish pattern. There's an easy potential for it to snap up. But again, closing at the low with inverted hammers is generally not a good look. So there we go. Apple is still strong, but there is potential for weakness here. Looking at Tesla, which reports next, what do we got? Well, gap is filled. We're actually technically closing a little bit higher than we began the week, but cup and handle is holding. So the cup and handle is holding. We cannot really afford to go much below 955 on the week. I'd also note that there is currently some distractions from Tesla with Twitter and what Elon Musk is trying to do there. So I don't know if that's going to have a material impact on the stock, but something we have to be mindful of. Now let's look at Amazon. Amazon is closing in with roughly a doji. Powerful down move last week. It's still roughly throttling about 3,000 here, about 1% above at 30.34. I don't really know what's going to happen. Big volume off the bottom and then just leveling off, going basically sideways. I'm looking at Microsoft. This is where it was strong. It was invalidating the head and shoulders, and now it's not. It's closing below the green line. So it is right on support here. Again, that big flux of volume that came in the last week of January is what's pretty much getting trapped here. Closing at the low of the week, gapping down, closing at the low of the week. This is not nice at all. So Microsoft has the chance to snap back because it's on support, but it could also further break down and actually test these yearly lows first. Remembering that it has one of the softest earnings beats that is expected, other than Facebook missing. Moving forward to Google. Google, again, respecting the downtrend, right? We got that big old green volume here. We're actually now below that entire range. And maybe part of the reason why it actually accelerated to the downside. Not a lot of volume yet, so it means that this week here is still trapped, right? They're trapped and perfectly respecting the downtrend. It's got a bear apex here, just has to crack. And it's pretty close to those yearly lows here, right? At about 2,500, we're off by roughly 2%. Really close like Microsoft here. Moving forward to NVIDIA. Oh, crap, right? This looks terrible too. Right back down to those yearly lows. It's only within about, about 2% too, right? Not really all that much further for it to actually crack and break bear. There's also quite elevated volume here with red bars starting to dominate. So, right, this is elevated volume for quite some time. And there we go. Looking at Facebook last, also where right on its green line, roughly testing the poking above the 200 weekly moving average, testing the relative low, and then stomped back down to the green line at roughly 210 to 207. So what does that mean? Well, again, we got big fat red volume and then leveling off and then not really doing anything. So now as we look back here to QQQ, we'll get a little bit more of a fresh perspective. And let's just delete all this stuff here to make sure we get the chart cleaned up. There we go. QQQ, one-day chart. Maybe now, oh, what? No, my lines got deleted. All right, anyways, I'm just going to redo this here. So let's use the magnet. Let's use a horizontal ray. There we go. Let's snap it down to that 334 area. Let's use the tool here. There we go, right? Make that nice and green because it's support. And then we're going to draw our downtrend, and we're going to find out here that it's the same thing pretty much. The volume is leveling off here. So as the volume levels off and we're approaching the key support area, not just for all of the individual tech stocks which make up the QQQ, we're noticing that QQQ volume is also leveling off. And again, that volume is starting to get trapped here. So it's very important where we go from here. So for the bulls, again, dipping into earnings, and we got to see what happens here. It's not really all that clear to me. All right, second thing here is just TINA. So for the bulls, we have to remember that, again, the US dollar is still the reserve currency. The stock market is still the best, but there is weakness across the world. So the US is still the best, but is it going to be enough? I don't know. Again, pricing power. I really, really, really want to see these trillion-dollar companies show us that they truly have pricing power. In terms of the military, again, there's no doubt that the US is still supreme. And in terms of politics, as of right now, even though Joe Biden is at a historic low for his presidency in terms of approval ratings, the world is united. So that's important for the bulls. In terms of the bears, pretty much all it's going to take is that Fed rhetoric to drive us lower. Earnings come in soft. Again, bonds in Europe are doing nothing. So that's seeing a flock over to, again, American bonds, which is driving up the TNX and adding pressure to tech stocks. And notably the balance sheet with a key with a key meeting coming up in May, and Jerome Powell speaking on Thursday after Netflix and Tesla report earnings. I really want to see what Jerome Powell says after all of his little lemmings and all of his little workers have gone out and driven the narrative, including Brainerd and everyone else, about the balance sheet has to run off at 2 times the rate from before. 50 basis points for May is definitely in play. And remembering that the rate rises are pretty much baked in. Goldman Sachs is calling for roughly up to 4%. So if Jerome starts saying we got to go do even more, he is pretty much saying that the market is not correctly priced. If he does not say very much, I think that he's going to be signaling that the market is correctly priced. And what's more important than anything for me is going to be whether or not we get any more clarity after we got the meeting minutes, again, which told us that we got $95 billion in runoff starting, and whether or not Jerome actually confirms anything. Because as we look here on the chart, we can note that as that balance sheet, again, looking over here at the orange line, the Fed balance sheet, as it starts to reduce, what do we see? As it starts to notably reduce, the market goes down. So as the balance sheet expands, stock market goes up. Balance sheet contracts or goes lower, stock market drops. So that's very important for us to keep in mind. It's very important to keep in mind too, because we've not really made significant progress in terms of bear market targets. We've hit in the 440s, we've hit in the 430s, we hit the 410s, but not quite the 400. So we do still have a gap at 400. And that 432 area is where we have a 10% drop off the all-time highs, which is technically correction territory. If we lose 400, again, DXY could be the only culprit to drive us lower. We get bad earnings. We get more US strength. What's going to happen? Dollar's going to go up. TNX is going to rise. Tech is going to drag us down. So that's pretty much all it's going to take. We get down to 380s. That's a 20% drop. And maybe where Jerome starts to get a little bit less hawkish, where he starts to dial back a little bit. Looking over to the S&P again, this is from our bear market 2022 playbook. It tells us that unless we're able to make a new all-time high, this pattern might 100% be in play. 150 months of expansion, 600%. Here we are. 154 months of expansion, 600%. If the top is in, we're not going to go to new all-time highs, which means we're going to get a sour reaction sometime this week, whether it's from earnings, whether it's from Powell, or from something else. Maybe, again, what's happening in Europe. I don't know. But that's where we sit, and that is what the market is currently looking for. Now, what we're going to do is go forward and look at some of these charts to get a better understanding of what is happening in the broader market. So as a reminder, we were looking for a quarterly chart here to drive our bull narrative, and pretty hard to argue that this is bullish, right? Down 3% on the quarter, right near support here. Right, hard to emphasize just how important that 435 area is on the monthly chart. Why? Well, looks like it might be going all the way back down to 420, which is the break even for those May 430 puts, and potentially even down to lower on the chart here. Looking on the monthly chart, here is where we start to see the story start to feed through a little bit better. As we noted, QQQ is currently about let's actually look at QQQ first here for the reference. So QQQ is almost basically back at its January lows, and off the all-time high, we're currently off by about 17%. If we go back down here to roughly 328, 10 points lower, we're now back down into a bear market for tech stocks. So if QQQ breaks this line at roughly 334.15, S&P is likely going to at least test this area in the high 420s. So that's going to be a really, really, really important area for us. Also important to note that, like I mentioned, we're halfway through the month. So this candle is roughly half done. And where we're going to land on the 28th, I don't know, right? Got to be mindful of the up or the down. Looking on the weekly chart, here is where we can note that, again, we poke above 454 once, which is our neckline going back to September highs. Poke above once, poke above twice with a lower high. Boom, there's the drop. There's the big snapback, though, too. So what's going to happen? I don't know, right? If we're really in a bear market, again, volume's also dropping off. So the next move is likely going to be the true one. Again, 4 weeks above the 50, pushing off here below the anchored VWAP, which means now the average person who's bought year to date, when we look at those monthly candles like this, where we see all that dip buying, they are now red, but we're not seeing volume to confirm they're actually flushed out. What does that mean? They're holding strong, but they could hurt us. So if we snap this line, again, what's in sight here? Mid 420s, right? Looking for roughly the mid 420s. And here on the daily chart, what's happening is that we've now closed below the 50 DMA for 2 consecutive days, back above for once, then the trap closing right back down below. Once we start getting more than 2 consecutive daily closes below the 50 daily, it's usually going to lead to us getting more downside, right? There's the 2, there's the lower low. Go back to here. Right, there's the 2 days below, there's the lower low. So just be mindful of that. The daily chart is definitely flashing a warning here. We can also note that we're pretty much back down here to the October area where we actually ripped higher. And what's going to happen? Again, I don't know. We're just battling for that area. It's a strong support area. Sorry, a supply area. And the high here is 431.54. So paying attention to that area. Final chart here, which is quite important for me. Short-term chart here, right? Short-term time frame. It's the hourly chart. We're noticing that the red volume is starting to dominate ever since we got this this big dive right here, which was driven by Brainerd. So, right, gap it up, pump it up, double top, flush it down, 4, 5, 6 pivot going back to our January support, resistance, 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 bull trap. Now we're lower. We're also in a funnel, which means that the price action is pretty much pointing down, and that is the path of least resistance right now. We have been bouncing pretty steadily between the upper and lower channel. And what this implies is that we would be here at roughly 432 if it lands perfectly into early Tuesday. And then what does that mean? Again, we got Netflix after the bell. We got Tesla the following day. And then we got Powell after that. That is the potential for the bulls. For the bears, all they got to do is smack it below that. Then we get down to roughly 428. And that could land anytime midweek. That would be the sour reaction to everything happening this week. So, at a high level, that is pretty much what we're going to be looking for here going into the next week. And if you're interested in watching what could happen in terms of the bear market potential, there's a video that's going to queue up here in a moment, which explains our bear market of 2022 thesis. With that said, I thank you for watching. I encourage you to be mindful of the downside risk and be ready for up, down, or flat. Thank you for watching. I would really appreciate a thumbs up and a comment if you were still watching. Thank you very much.